Thank you, Ryan. Hello and welcome everyone to this evening's live event, Making the Grade, Factor Investing with A+ Investor. Like Ryan said, my name is Derek Hageman. I'm a financial analyst at AAII, and I'm the editor of AAII's Dividend Investing, and I'll be serving as tonight's moderator. The American Association of Individual Investors is an independent, nonprofit group that helps individuals become effective managers of their own assets through programs of education, information, and research. This weekly webinar series is an extension of AAII's educational mission and allows us to reach members and individual investors literally around the globe. It is my pleasure to introduce tonight's speaker, Wayne Thorp. And Wayne certainly wears a lot of different hats at AAII. Wayne has his CFA designation and is the lead analyst and editor of the Stock Superstars report. He is also the senior financial analyst and a vice president at AAII. He has written extensively on technical analysis, quantitative stock screening, and fundamental stock analysis. Wayne is also the product manager for the A+ Investor Investment Discovery, Analysis, and Tracking Service, and for the Stock Investor Pro Fundamental Stock Screening and Research Database Software. Wayne also serves on the Dividend Investing Advisory Committee. Welcome, Wayne, and thank you for joining us.
Thank you, Derek. I hope you might need some oxygen with that mouthful you just did there at that mile-high altitude.
Well, yes, I am coming from Denver tonight, so still trying to get used to the altitude. And, with everything on your plate at AAII, I'm glad to see that you have some well-deserved vacation time coming up. Is there anything you can share with us about what you'll be doing during the break? I heard a rumor that there might be some fly fishing on the agenda.
Not that I'm counting down, but Saturday morning I will be driving up to Michigan to see my mother and sister, whom I've not seen since Christmas, being sure to practice safe social distancing. And then on Monday, I'll be driving up to northern lower Michigan for a few days with my godfather to be fly fishing on the Osable and Manistee rivers. And I cannot wait.
Well, that sounds like a ton of fun. Enjoy your time off. But before that, please take it away, Wayne. We look forward to hearing your thoughts on making the grade, factor investing with A+ Investor. Thanks, Wayne.
Thank you, Derek. Good evening, everyone, and welcome to the latest installment of AAII's Webinar Wednesday series. I'm Wayne Thorp, the Senior Financial Analyst at AAII, and I want to thank all of you for joining me tonight as I discuss factor investing and the tools AAII offers to perform factor analysis of stocks. I've been involved with quantitative stock screening since my very first day at AAII back in 1997. One of the primary goals of stock screening is to quickly identify stocks exhibiting fundamental characteristics that, historically, indicate promising candidates. As a value investor, I like to follow screening strategies that adhere to Graham and Dodd, looking for stocks trading below their intrinsic value based on earnings, sales, book value, or dividends. What Graham and Dodd advocated eventually became known as value investing and turned out to be one of the earliest forms of factor investing. So tonight, I'll be talking about factor investing, what it is and why it matters. I will then highlight some factor-based tools that AAII has created as I walk you through an analysis of an actual company. So with that, I'm going to switch off my webcam so you can focus on my slides. So just to kick things off, what exactly are factors? Well, factors are quantifiable firm characteristics that can explain differences in stock returns. Over the last 50 years, academic research has identified hundreds of factors that impact stock returns. In fact, researchers and academics have identified so many factors, many of which have little value, that John Cochrane of the University of Chicago coined the term zoo of factors in his 2011 presidential address to the American Finance Association. Pardon me, frog in my throat. There has been an explosion in the number of factors in recent years. However, not all of these so-called factors are able to provide market-beating returns across all market segments and over varying time periods. So the need has arisen for a set of criteria to identify truly meaningful factors. So in order to be a factor, the characteristics must first be able to generate premium returns. Also, many of the characteristics that are discovered actually generate premium returns because of their interaction with or close relation to another factor. So to be a factor, the risk and return must be attributable to that factor and that factor alone. To further help investors separate the wheat from the chaff when it comes to the zoo of factors, Larry Swedroe provided 5 criteria that a factor should be required to meet before the premium can be expected to continue. He outlined them in his book, Your Complete Guide to Factor-Based Investing. To be considered a factor, Swedroe requires that it be persistent, pervasive, robust, investable, and have logical, risked, or behavioral-based explanation. So let's take a look at these criteria one by one. As I alluded to earlier, a factor must have risk and return that cannot be explained away by factors that already exist. In other words, it must provide additional explanatory power beyond the factors already in use today. This is a very tall order and a key reason why there are so few factors used regularly and successfully. What a factor needs to generate premium returns is kind of a generate premium returns is kind of a no-brainer. Why would we want to invest in stocks exhibiting characteristics that don't beat the market? To be considered a factor, the characteristic cannot exist only in a short time frame or in a narrowly defined market conditions. Factors must persist across all phases of the economic and investment cycle, which can last many years. A factor must be pervasive around the globe and across asset classes. This means a factor cannot only generate premium returns among a narrow segment of stocks, such as Michigan timber companies. A robust factor holds for various definitions. For example, there is a value factor or premium, no matter if it is measured by price to book, price earnings, price to sales, or price to cash flow. A factor that does not meet this criteria is most likely the result of data mining. The requirement that factors must be investable is actually a very good point. Too many times, promising theory falls apart when it is introduced to the real world. An investable factor not only passes muster in a theoretical framework, but it can also be implemented and holds up to real market forces. The last criteria a factor must meet is to be intuitive. This means there are logical risk-based or behavioral-based explanations for its premium and why it should continue to exist. So for example, let's consider the value premium. I'm a fan of value investing because there's a mountain of research as well as real-world performance proving that value-based stocks outperform high-growth stocks over the long term. For many investors, knowing this has been the case and that will most likely continue is more than enough. However, the intuitive explanation for the value premium is that value firms have riskier earnings and profitability compared to growth firms. These are intuitive risk-based explanations for that premium. While factor investing has become a hot topic over the last decade or so, its roots date back to the 1930s. At the time, Ben Graham and David Dodd were advocating value investing, and in the 1949 book Intelligent Investor, Graham was urging investors to buy stocks at a discount to their intrinsic value. The first real attempt to quantify the sources and drivers of stock returns came in the 1960s with the advent of the single-factor capital asset pricing model, or CAPM. The CAPM postulates that there is only one factor, beta, and that stock returns are driven by the market beta and company-specific risks. The beta of a potential investment is a measure of how much risk the investment will add to a portfolio that looks like the market. If a stock is riskier than the market, it will have a beta greater than 1. If a stock has a beta less than 1, the formula assumes that it will reduce risk of the portfolio. A stock's beta is then multiplied by the market risk premium, which is the return expected from the market above the risk-free rate. The risk-free rate is then added to the product of the stock's beta and the market risk premium. The result should give an investor the required return or discount rate that they can then use to find the value of an asset. However, there are several assumptions behind the CAPM that have been shown not to hold in reality. Modern financial theory rests on 2 assumptions. 1, securities markets are very competitive and efficient. That is, relevant information about the companies is quickly and universally distributed and absorbed. And 2, these markets are dominated by rational, risk-averse investors who seek to maximize their satisfaction from returns on their investments. Over the years, however, which has actually become its own field of study called behavioral finance, this has shown that neither of these are always the case. In the early 1990s, Eugene Fama and Kenneth French published their landmark findings, which started with the observation that 2 classes of stocks tended to do better than the market as a whole. 1, small caps, and secondly, stocks with high book-to-market ratios or low price-to-book ratios. From this research came the Fama-French 3-factor model to describe stock returns. The 3 factors in this model are the market risk or beta, the outperformance of small versus big companies, and the outperformance of low price-to-book versus high price-to-book companies. Research indicates that the Fama-French 3-factor model explains over 90% of the diversified portfolio returns, compared with an average of 70% given to the CAPM. Trying to explain this last 10% of returns probably contributed to the zoo of factors. However, the definitions Swedroe and others have created, however, using the definitions that Swedroe and others have created, here are some of the more widely accepted investment factors. These will include value, profitability, quality, growth, earnings estimates and earnings surprises, and low volatility. As investors hear about the merits of factors and factor investing, the question inevitably becomes, how do I make use of factors in my own investing? There are a growing number of factor or smart beta mutual funds and ETFs, some of which invest based on a single factor such as value, quality, momentum, or size, while others use a multi-factor approach that seek to provide exposure across a variety of factors. For investors looking to select stocks themselves based on proven factors, AAII created unique factor-based stock grades that are part of our new A+ investor service. These grades aim to score stocks based on value, growth, momentum, quality, and earnings estimate revisions and surprises. So now I'm going to take some time to discuss the basis for these factors and their underlying fundamental variables. As I mentioned earlier, value investing goes back to at least as far as the 1930s with Graham and Dodd. Value investing refers to buying stocks of companies with low multiples relative to fundamental metrics such as book value, earnings, cash flow, EBITDA, and so on. It's often referred to as buying what is cheap, as opposed to growth investing, which buys companies with high prices relative to fundamental metrics, and thus referred to as expensive. Historically, cheaper stocks have earned higher returns than expensive stocks. However, just as stock selection strategies fall into and out of favor, so too do individual value measures. Research also shows that some factors become less effective over time due to accounting changes and structural changes in the market. Research by James O'Shaughnessy for the 4th edition of his best-selling book, What Works on Wall Street, uncovered that combining multiple value factors into a composite yielded better, more consistent, and less volatile results than relying solely on one factor. Growth investing is the opposite side of the investing coin from value. Growth investing is an investment strategy that focuses on businesses that have the greatest potential to grow explosively in both size and importance within their industries. The stocks that growth investors seek often look expensive or overpriced compared to the current revenue and earnings their businesses generate. However, investors are willing to pay more for these growth stocks because of the potential for extraordinary returns for those who discover them early on. Growth investing tends to carry with it higher risk because when growth stocks fail, they often fail spectacularly. Growth investing requires a willingness to accept heightened levels of risk in the hopes of capturing extraordinary returns. Thomas Rowe Price Jr., who is pictured here on slide 20, has been called the father of growth investing because of his work defining and promoting growth investing through his company, T. Rowe Price. Also influential in shaping this investment style was Philip Fisher, whose 1958 book, Common Stocks and Uncommon Profits, is still used as a reference for identifying growth companies today. The foundation of growth investing is the notion that stocks of companies exhibiting strong, consistent, and prolonged growth outperform those of slower growth companies. Growth has several dimensions, including year-over-year increases in sales and earnings, longer-term historical sales and earnings growth, and analyst forecasted long-term earnings growth. However, growth analysis can also take place across the income statement, balance sheet, and cash flow statement of a firm. At the most basic level, momentum investing in the context of stock selection can be defined as buying stocks that have done the best over a given time period, usually up to 12 months, and selling those that have done the worst. However, there are multiple methods and timeframes used to measure momentum. Research has shown that stocks with low returns over the past year tend to have low returns for the next few months, and stocks with high past returns tend to have high future returns. Momentum has also been shown to be a useful complement to value investing. For value investors, the sweet spot in investing is being able to buy an undervalued stock right before its value is recognized by the market and just before its stock price begins to take off. But how can a value investor tell when a stock is in the sweet spot? One strategy is to identify stocks with good value that are just starting to exhibit good momentum characteristics. This helps you avoid value traps or the proverbial falling knives, as well as stocks whose value will never be recognized by the market. The term quality, especially when it comes to investing, is a subjective term. There is a substantial amount of research that illustrates the merits of investing using quality factors. Quality often refers to companies with low debt, stable earnings growth, and profitability. However, there is also research into quality that has found that high-quality companies have higher returns on equity or lower accruals, which is roughly measured as the difference between operating cash flow and net income. Quality's leading industry proponents include Jeremy Grantham of asset management firm GMO, who developed high-quality indicators of high return, stable return, high return, stable return, and low debt. As well as Joel Greenblatt, whose little book that beats the market encourages value investors to pay attention to capital productivity, measured by return on invested capital, in addition to valuations. Stock prices are established through expectations and adjust as those expectations change or are proven wrong. A slight change in projections can have a major impact on stock prices, especially if the multiple or price earnings ratio investors are willing to pay for a given level of earnings also expands or contracts. Stocks with high price earnings ratios not only have high expectations, They also possess a higher anticipated certainty of realizing that growth. Lower multiples reflect lower perceived prospects, as well as greater risk and uncertainty of achieving results. When using earnings estimates, the first rule to consider is that the current price generally already reflects the consensus estimate. There is nothing to be gained by simply looking for companies with high levels of expected earnings growth. Studies show that over the long run, stocks with high expected earnings growth tend to underperform stocks with lower expected growth. It is difficult to continually meet and exceed high expectations over an extended period, commonly referred to as reversion to the mean. The most profitable earnings estimate strategies focus on surprises and revisions. As earnings surprises occur, when an earnings surprise occurs when a company's reported quarterly or annual profits are above or below analyst expectations. Stock prices of firms that significantly exceed analyst expectations or generate positive earnings surprises tend to outperform the market, while those with negative surprises tend to underperform. The impact of the earnings surprise is longer lasting than one would think. Pardon me. The greatest effect of the surprise can be seen immediately, but the impact of the surprise can also be felt for as long as a year. The impact tends to be longer lasting for negative earnings surprises. It simply takes time for the market to recognize that a fundamental shift is taking place in the company. This means that it does not generally make sense to be a bargain hunter and buy a stock after the initial price decline on a negative earnings surprise. There is a good chance the stock will continue to underperform the market for some time. Changes in estimates reflect changes in analysts' expectations of future performance and lead to price adjustments similar to earnings surprises. When earnings estimates are revised significantly upward by 5% or more, stocks tend to show an above average performance. Stock prices of firms with downward revisions show below market performance. In addition, analyst estimates are more meaningful when individual estimates move away from the average rather than towards the consensus. Lower valuation stocks react more favorably to positive surprises and upward estimate revisions, while higher valuation stocks react more adversely when expectations are missed or estimates are revised downward. So having laid the framework for the A+ stock grades, now let's take a look at them one by one. The A+ value grade is based on the percentile rank of the average of the percentile ranks of the price to sales ratio, PE ratio, enterprise value to EBITDA ratio, shareholder yield, price to book value ratio, and the price to free cash flow ratio. So basically what we do is we look at the percentile ranks for these 6 values, average the percentile ranks of those 6 or however many that have a valid value for any given company, and then we re-rank that average. So it allows for an equal distribution across the A, B, C, D, and F grades of the A+ grades. The enterprise value to EBITDA ratio is used as a valuation tool to compare the value of a company, debt included, to the company's cash earnings less non-cash expenses. Enterprise value is a measure of the company's total value, often used as a more comprehensive alternative to equity market capitalization. Enterprise value includes in its calculation the market cap of a company, but also short-term and long-term debt, as well as any cash on the company's balance sheet. EBITDA, earnings before interest, taxes, depreciation, and amortization, is a measure of a company's overall financial performance and is used as an alternative to simple earnings or net income. However, for asset-intensive firms, EBITDA can be misleading because it strips out the cost of capital investments, such as property, plant, and equipment. Just like the PE ratio, the lower the enterprise value to EBITDA ratio, the cheaper the valuation for a company. Another of these values that I'd like to touch upon that may not be familiar to some investors is the shareholder yield, which is a valuation measure that aims to capture the benefits of both dividends and share buybacks. Shareholder yield is the sum of a stock's dividend yield and the percentage of net share buybacks over the previous 12 months. It is a useful tool for identifying good management teams. The rationale is that the market usually doesn't react kindly to cuts in dividends or suspension of share buybacks. So managers usually want to ensure that the company is on sound financial footing before implementing either one. The A+ Investor Growth Grade looks at quarterly year over year, which is the latest completed quarter compared to the same quarter the year ago, and average annual growth over the last 5 years in sales, fully diluted earnings per share from continuing operations, and cash from operations. The A+ Investor Momentum Grade is derived from a score reflective of the stock's weighted 4-quarter relative strength rank. The relative strength rank indicates how well a stock has performed over a specific period of time, in this case the past 4 quarters, relative to all the other stocks over the same period of time. The weighted relative strength for the past 4 fiscal quarters is calculated with the most recent quarterly price change given a weight of 40%, and each of the previous 3 quarters given a weighting of 20%. The A+ Investor Estimate Revisions Grade ranks companies by the strength of their recent quarterly earnings surprises and earnings revisions for the upcoming fiscal quarter over the last month and the last 3 months. The last fiscal year. Over the last month and the last 3 months. The Estimate Revisions Grade considers the SU score, which is a measure of the magnitude or significance of earnings surprises. The SU score measures the earnings surprise in terms of the number of standard deviations above or below the consensus earnings estimate. So a stock with a wide diversion of earnings estimates may not have as meaningful a surprise as a company with a narrow dispersion of estimates with the same percentage surprise. The A+ Quality Stock Grade ranks companies based on management's use of accruals, asset turnover improvement, earnings estimate revisions, buyback yield, and dividend growth. Accruals are revenues earned or expenses incurred, which impact a company's net income on the income statement, although cash related to the transaction has not yet changed hands. Accruals also affect the balance sheet, as they involve non-cash assets and liabilities. Accrual accounts include, among others, accounts payable, accounts receivable, accrued tax liabilities, and accrued interest earned or payable. Accrual accounting introduces many interpretations and estimates by management into the financial statements. Decisions regarding the capitalization of expenses, the recognition of revenue, the creation of reserves against losses, and the write-off of assets are examples of just a few of the elements that may vary from firm to firm. Many of these issues are factors that relate to the quality of a firm's earnings. Overly aggressive use of accruals can lead to future write-downs, which ultimately hurt the stock's price. From an earnings quality standpoint, the closer a company's operating cash flow and net income are, the higher the quality. This means there are fewer adjustments to net income that reflect the accounting assumptions made by management. This, in turn, indicates that a more conservative accounting approach is being taken, which is an indicator of higher quality. As an A+ Investor subscriber, you have access to a stock screener, which allows you to isolate companies exhibiting specific factor grades. So for this presentation here on slide 33, I created a screen for stocks with grades of B or better across all 5 A+ stock grades: value, growth, momentum, EPS revisions, and quality. As of June 19th, 19 companies out of the roughly 6,100 companies in our database met these filters. One of the companies passing the stock grade screen that I created was Patrick Industries, ticker PATK. Patrick Industries is a manufacturer of component products and a distributor of building products and materials for the RV and manufactured housing markets for customers throughout the US and Canada. In addition, it is a supplier to other industrial markets, such as kitchen cabinet, office and household furniture, fixtures, and commercial furnishings, marine, and other industrial markets. Patrick manufactures a range of products, which includes solid surface granite and quartz countertops, fabricated aluminum products, profile moldings, cabinet doors and components, and hardwood furniture, among others. Here on slide 36, we see the stock evaluator page for Patrick Industries with the A+ stock grades. We can see from this page that the company rates a B for value, growth, and EPS revisions, and an A grade for momentum and quality. On this page, you can also do a deeper dive into the individual components of each grade, which I'm going to walk you through now. The value grade looks at the percentile ranking across for all 6 variables, and a company must have at least 2 with valid or non-null values. The calculation takes an average of all of the individual percentile rankings and then re-ranks the average for all stocks. This makes the distribution roughly equal across all 5 letter grades. Those companies that do not have a non-value score for at least 2 of the 6 components of the value grade receive a null grade. Here we see the 6 metrics that make up the overall value grade. Patrick has valid values for all 6 components, and for 5 of the 6 fundamental variables, Patrick is more attractive than its sector, with the exception of the price to book. It also ranks in the bottom 50%, lower being better in the value context, with price to book being the exception. This is actually a reason why O'Shaughnessy suggests using composite scores when considering valuation. Had you been looking at only the price to book ratio, you may have skipped over Patrick Industries, especially if you're a value investor, as it ranks in the 65th percentile among all domestically listed stocks. Personally, I wouldn't view the 65th percentile for price to book as a value ranking. So if I was a value investor, I probably would have moved along or ignored it completely. However, in aggregate, Patrick ranks in the bottom 30% using all 6 variables, which puts it in the B or value range. Patrick has a growth score of 62, based on the average of the percentile ranks of the 6 growth measures used for the A+ growth grade. The A+ investor growth grade looks at quarterly year over year, which is the latest completed quarter compared to the same quarter the year prior, and the average annual growth over the last 5 years in sales, fully diluted earnings per share from continuing operations, and cash from operations. Patrick scores very highly when looking at longer-term 5-year growth, but has struggled more recently when comparing year-over-year growth for the last quarter. And actually, that's not surprising, being in an industry that is tied very closely to disposable income and whatnot. So it's not surprising that it's seen some struggles over the most recent quarter. For the momentum grade, Patrick ranks in the 91st percentile in terms of the weighted 4-quarter relative strength. This is attributable mainly to the 152% price increase the stock has seen over the last 13 weeks. So definitely, if you had latched onto this a quarter or so ago, you would have been very happy at the moment. For the estimate revisions grade, Patrick scores a 70, which is positive. The company ranks highly based on its SU score for the last 2 reported fiscal quarters, both of which were above 2. This means that the difference between Patrick's reported earnings and the consensus estimate was more than 2 standard deviations away from the average. As a rule of thumb, in this case, a SU scores above 2 are generally considered meaningful. Analysts have also been strongly upwardly revising their estimates for Patrick's current fiscal year, as the consensus estimate has risen nearly 13% over the last month. The caveat being, however, that the consensus estimate has fallen almost 50% over the last 3 months. Patrick satisfies 4 of the 5 quality pass-fail tests, failing only the asset turnover improvement test. Asset turnover fell to 1.7 in fiscal 2019 compared to 2.2 for the prior fiscal year. Total asset turnover measures how well the company's assets generated sales for a period. Too high an asset turnover ratio relative to other firms may indicate insufficient assets for future growth in sales generation, while too low an asset figure points to redundant assets or low productivity levels. So that concludes my walkthrough of the individual grades, but I want to touch on a couple other tools that A+ investors have that make use of the A+ stock grades. So another way in which you can track A+ stock grades is with the upgrades downgrades table that we make available at the A+ area of AAI.com. Here you see separate listings for companies that have seen 2 or more upgrades or 2 or more downgrades across all 5 A+ stock grades. So you can see here on slide 42, for example, Cabot Corp, ticker CBT, has seen an upward revision and its momentum and its estimate revisions grade. Let's see if none show up with 2 downward revisions, but again, these are a listing of companies that have seen at least 2 or more upgrades or downgrades across all of the different A+ stock grades. If you're an A+ investor subscriber who sets up a portfolio using AAII's My Portfolio tracking tool, you can also see the latest grades for all of the stocks you hold in your favorited portfolio. So this is an example of a portfolio that I've set up using the My Portfolio tool, and it's strictly stocks, and then you can see then all of the different grades that of all the stocks in whatever portfolio that you might have favorited. And it's also worth pointing out that each of these columns are sortable as well. So you can, for example, sort your list by companies that have value A to F. So again, fully sortable. So that concludes my regular remarks for this evening. But before I turn things back to Derek for the Q&A portion of tonight's program, I want to mention a special offer for tonight's attendees. If you're interested in the stock grades I covered tonight, they are just one of the useful investment discovery, analysis, and management tools that are part of the new A+ Investor Service, of which I am the product manager. You can go to the URL on slide 44, www.aai.com/store/A+ and for only $1, you can test drive this powerful online investment suite built in-house by AAII. So this wraps up my remarks for this evening, and thank you very much for spending part of your evening with me. I am now going to open things up for questions, but before I do, also know that if you have any questions after the fact, you can reach me at Wayne, W-A-Y-N-E, at AAII.com with any questions, suggestions, or comments. So Derek, I'm ready to take some questions.
All right, excellent. Thank you very much, Wayne. That was a very informative presentation. Appreciate it. There have been a lot of questions that have come through, so let me just pull up the questions that came through and start off with, here's one from Mark. Mark asked, are there factors available for preferred stocks?
At this point, our database does not cover preferred stocks. We are always looking at ways to enhance the A+ service, and preferreds as well as closed-end funds are 2 things that have come up very often as far as lacking coverage in our database. So currently they are not available, but we are looking into the potential of adding those in the future.
Okay. We had one participant tonight, Paul. He had a bit of a sense of humor. He asked if Mr. Thorp is shorting Procter & Gamble and their key product, Gillette razors.
No, actually, I figure if I'm going to the North Woods of Michigan, I need to look the part. So hopefully, I can get away with it at least one time.
Let's see, there have been several questions, Wayne, around the fact of people would just like to hear your thoughts about value outperforming growth over the long term. And I guess some people have specific questions about what is considered long-term, and just really want to hear your comments, because a lot of people are saying that, you know, growth has outperformed value over the last few years. So just wanted to hear your comments in general.
Well, actually, for at least the last 10 years or so, value is definitely in the middle of a pretty strong slump. There's definitely no way around that. You know, I still am a firm believer in value investing. You know, for example, I'm also the lead analyst and editor of the Stock Superstars report, and our group 4 strategy follows the strong contrarian strategy of John Neff, and a very strong contrarian strategy has been one of our top performing groups since its inception, and has continued. It's seen a little bit of a slump over the last year or so, but it's still held up reasonably well. So I still think there are advantages and definitely pockets for value, but value historically does underperform in the middle of a strong market. And you know, we've been outside of the blip we had recently. You know, we've been in pretty much a continuous bull market now for over a decade. So that's where it comes down to discipline and a little intestinal fortitude. You know, sticking with a strategy, but also, you know, diversifying across styles as well. You know, that's you know, or at least as I alluded to, you know, integrate something like momentum into your value strategy to maybe find value stocks that are on that upward slide. So yes, value definitely has been in a slump. I have no idea how long that will last. I still believe in the concept of value, and then it's a matter of, again, diversifying across styles, or maybe trying to find ways in which you can enhance a value strategy, such as using momentum.
All right, thank you. Let's see, Ken, among others, asked, has A+ Investor been back tested? And if you could just, if yes, could you just talk about the process a little bit?
We did back test it. It wasn't the same level of back testing we would have done if it was more of a stock strategy. But as we were putting these things together, we did do extensive back testing, more on a like quarterly, biannual basis, just to get a feel for these different factors and whatnot. All of them did well. All of them outperformed the market. The one caveat that we found interesting was on the quality side of things. And as I learned more about quality, it actually makes sense now. An A grade for quality doesn't necessarily mean that it's going to outperform the market. But we found that quality in other research, such as research by O'Shaughnessy, has found that quality is actually a very good exclusionary screen or tool. Basically, we found that stocks that rate an F in quality tended to underperform more greatly stocks that had A, B, C, or D grades. So we did do some back testing. It was not as a formal methodology as we would have done for example, like if we were introducing a new stock strategy. But back testing was done in order for us to feel confident in putting these factors out into the real world.
All right, thank you. There have been several questions, participants asking, what is the difference between A+ Investor and Stock Investor Pro?
Okay, excellent question. A+ Investor is a sort of a fully focused investment discovery, analysis, and tracking tool. It covers stocks and mutual funds and ETFs. It includes portfolio diversification analysis and insights for those people that create portfolios using the A+ Investor. It offers these, for example, the stock grades are not part of Stock Investor Pro. Stock Investor Pro is a software-based fundamental stock screening application. So you can use it to run any of our 60 or so predefined stock screens that are built into it. You can also then use it to build your own screens using any of the roughly 2,200 data points per company that are available. So A+ Investor is sort of the full process, discovery, analysis, and tracking stocks, mutual funds, and ETFs. Stock Investor Pro is a fundamental stock screening application.
Okay. There was one question from a member asking if they wanted to learn more about factor investing. Do you have any book recommendations you'd like to share?
Well, I would definitely recommend any book. Actually, the fourth edition of What Works on Wall Street by James O'Shaughnessy. I've been reading that extensively over the last couple of months. Jim puts things together very well, very easy to understand. So I would say if you're looking to get a head start on factor investing, definitely there. It's also a good combination if you're really a number cruncher. He gives you a ton of data that you can digest as well. But he goes through and he's back tested pretty much every significant factor that's out there over 70 or 80 years and gives you a breakdown of the performance. So I strongly recommend, if you want to learn more about factor investing, definitely start with Jim O'Shaughnessy's book.
Okay. Let's see. A lot of questions are still coming through. Let's see. Are there any factor premiums that are shrinking or increasing? Have you seen any studies on that, Wayne?
The one study that I keep seeing over and over is that there is the potential for a shrinking premium on the price to book ratio. And a lot of that is tied to changes in accounting standards and whatnot, and that a low book value might not be as strong a value component as it once was. That's the one that I've seen the most, but I still see. I go to the Advisor Perspectives website quite a bit. They always have some quality commentary and research there, and almost on at least almost a weekly, if not monthly basis, someone else is putting out more research that's confirming that momentum still works, that quality still works, et cetera, et cetera. Pardon me.
We have one question here. Are there plans to have an overall grade, or how should one think about the different factor grades contributing to an overall grade?
That's a very good question. We actually pondered that when we went live with A Plus Investor, and that's still something that we are talking about. But yeah, the question then becomes, how do you weight this? That's ultimately the reason why we didn't. But we were even talking about creating a tool where basically, you can come up with a composite. So if we've got the 5 stock grades, if I view them all on equal weighting, then it will look at a stock and look at its individual stock grades and weight each of those grades equally to come up with a master grade. Or I'm very much a value investor, so I'm going to give the stocks value grade 70% of the weighting and maybe only 15% in quality, 15% in momentum, things like that. So short answer, we currently don't have a master grade, but that's something definitely that we've been thinking about. And if not offering one ourselves, at least offering tools where the individual could come up with their own overall grading based on adjusting the weightings across the 5 grades.
Okay, great. Sounds like there's some more features to come in the future, so people should definitely stay tuned.
Absolutely.
There was a question from Stephen. He asked, and I think he was referring to one of the earlier slides where there was a list of different factors. He was asking, what is the carry factor?
Carry is more on the side of bonds. It's the cost of carrying the debt, so it's interest, things like that. So that tends to be more on the bond and debt side of things.
Okay. Here's a good question, I think, from James. He asked, how do I use the A+ stock factors to avoid value traps?
The biggest way in which you would try to avoid a value trap is looking for, and actually that's something that I use as a screen that I run. I basically look for stocks that have an A value grade, a momentum grade, or a B or better, and then I kick out any stocks that have an quality of F. So basically a quality score of D or higher. That's normally my starting point for trying to find some value stocks that are on the move.
Okay. Let's see. We have one question from Paul. He asked, how does A+ Investor differentiate itself from other grading tools that are on the market?
I think, there are a lot out there. I think it's probably some of the underlying values that we use on some of these is probably going to be the bigger differentiator. But I also think in some ways and some people might view this derogatorily, but they're also a little more simplistic. So I don't think I run across some grades that have so many factors and they're so overly complex. And I'm of the opinion that increased complexity doesn't necessarily boost usefulness. So I think it's some of the variables that we're probably using on the underlying side of things, as well as then hopefully these are more intuitive, to use one of the requirements for a factor, more intuitive than some of the other ones that are out there.
Okay, thanks, Wayne. We have another comment question from Roger. He commented, he said, I would love to see some step-by-step instructions for using this facet of A+ Investor. Are these available?
So, I write a weekly, I write a weekly commentary for A+ Investor that I think really discusses, gives people a way in which to learn more about how they can use A+ Investor. We've obviously, with the unique situation that we're in with shelter in place and whatnot, we've started just really jumping into webinars. I do know that we're in the process of going to be putting together, sort of a working title, Ask Me Anything webinars, where on a rotating basis, the different editors, so Derek for dividend investing, myself for A+, SSR, and Stock Investor Pro will host webinars where basically they're just Q&A sessions for subscribers, sort of a free-for-all, asking about how to use it, asking questions about the service, things like that. So this is all of this is a work in progress. I think we've gotten off to a great start with these webinars, but I would say stay tuned, because I believe we will probably be in the next month or so starting to launch these regular Ask Me Anything sessions.
Hey Wayne, can you please switch back to your slides?
I am.
I'm not seeing that. There we go.
Okay, I'd stopped sharing my screen. I apologize.
No worries.
I don't know what you were seeing, but.
All right, let's see. We have, I think this is a very good question. Harry asked, what kind of stocks does A+ screen for in terms of size? For example, large cap, mid cap, small cap. We saw that in some of the early French pharma studies that size was a factor. Does A+ Investor take that into account?
A+ does not take size into a factor account. That is not a factor that we've currently done. I think the primary reason why is to allow us to differentiate our shadow stock portfolio, which is a microcap value portfolio. But we're always looking. I have no doubt that in the coming months or longer, we might be tweaking individual factor grades to improve upon the underlying variables that are used, as well as coming up with additional size being one of them. But currently, we do not have a size grade.
Okay. And we still have some questions coming in. Do you still have time to answer a few more, Wayne?
Absolutely.
All right, great. One participant asked, is there one factor that has done particularly well during the fallout from COVID? For example, momentum?
To be brutally honest, I've not been staying up on as far as the individual factors go. Whomever asked that question, definitely feel free to, if they're still on, to send me an email at wayne@aai.com, and I can do some poking around. But it seems like, at least on the down days, everything was down. It looks like, definitely more growth momentum, I think, anecdotally, has been performing better as the market has been rebounding since that sharp drop. But I don't want to give out necessarily incorrect information based on faulty assumptions. So whomever asked that, if they want to hit me up by email with that question, I can certainly look into that.
And again, just to let everyone know, we do receive more questions than we have time for. So I know Wayne will be looking at the questions after the webinar is finished, and as a team, we'll try to answer as many as we can over the next few days. So just so everyone keeps that in mind. There have been a few.
One other thing, Derek, too. Actually, I do review these, and I will integrate some of these questions into a Q&A in the weekly Making the Grade A+ investor email as well. So definitely if you're a subscriber, definitely follow that email as well, because inevitably I'll be answering some questions in that in the coming weeks.
No, that's a great point. Thanks for adding that. There have been a few questions. Just people would like if you could just repeat what the trial offer is again.
Certainly. Let me. So it's a $1 trial, and with that, then you get unlimited access to A+ Investor. I believe it's for a month, and it gives you an opportunity to kick the tires. You'll be able to go through our onboarding process where I've created a bunch of hopefully useful information on how do people get started using all the different tools A+ Investor. So again, basically it's a risk-free offer. Just you're emptying up that $1 for that 1 month of access. And then just to dispel inevitably, I get some of these questions as well. It's important to reiterate that A+ Investor is not a portfolio. This is not an advisory service. This is a investment discovery, analysis, and tracking tool. So if you're a mutual fund or ETF investor, we didn't touch on that here, but we have a whole slew of tools and resources for mutual fund and ETF investors as well as the enhanced elements of the My Portfolio tool.
Yeah, I'm glad you mentioned ETFs and mutual funds, Wayne, because there have been several questions about that, and it probably sounds like that might be a good topic for a future Wednesday webinar. So I'm sure people will be seeing you at some point, and we can cover that. We know a lot of our members are ETF and mutual fund investors, and this A+ Investor is a great tool for those as well. So.
Oh, absolutely. There's so many elements to A+ Investor that we could chunk this up and probably do 7 or 8 webinars very easily. So stay tuned.
Let's see. I'm just looking for a couple more. There was a question, and I know you said just because of everything that's on your plate right now, you haven't been able to focus on individual factors, but there was a question. The opposite, have there been any factors that have done particularly poorly since the S&P index peaked on February 19th?
I think value has been struggling of late. I think when anxiety starts to rise, people, there's that perceived weakness in low valuation stocks. There are a lot of stocks out there that have low valuations because they deserve that. But in other cases, in many cases, I believe there are quality companies that might have stumbled along the way, and the market has overreacted and pushed the stock price down. But when anxiety rushes up, people perceive growth and momentum with quality, which isn't always the case, but that is what's happening, I think, here. So value, I think, has been lagging since the peak of the S&P, but more so even than it had previously.
Okay. Let's see. There was a specific question on slide 26. Just a question. Do you know why value looks so evenly distributed versus some of the other factors?
Yes, and if I didn't allude to that, I apologize because it was in my notes to do so. So yes, oh, it was a hidden slide. I know what slide you're talking about, though. The reason why those are equally distributed roughly across the different letter grades is because the first thing we do is we take the average for all of the 6 variables. We take the average of the percentile ranks for each of those 6. If we just took that average and then chunked that up into different areas, you would inevitably see more of maybe a bell curve or something like that, where they don't see an equal distribution. But what we did then is we took the averages for all of the stocks, the average we arrived at by taking the average across all these factors for all the different stocks. And then we re-ranked that. We set up a percentile ranking based on that. So it's very much more evenly distributed across the 0 to 100 percentiles. So that's why you see that more equally distributed distribution for the different letter grades for the value grade.
Okay. And can I just squeeze one more in? We do have a participant, Billy, who has asked several questions. And one that I have here, he was asking specifically about the quality grade for Patrick.
Mm-hmm.
He says 4 out of 5 comes to 81%. Can you just explain how we arrive at 81% for the quality grade?
It's probably most likely as we do a percentile ranking of those pass-fail indications. So yes, it's not 4 out of 5 equals 80%. Is then we take a percentile ranking of those those scores. So basically, it'd be a 0 to 5. No, it'd be a 0 to 6, and then we rank it that way. No, 0. It's the 5. So, but we rank whatever the number of pass fails. We rank that number. So it's not a 1 out of 5 is 20%, 2 out of 4 is 40%, something like that.
Okay. All right.
Billy, if that didn't answer your question, definitely don't hesitate to reach out to me in the future.
Okay. Well, I think with that, we want to thank you, Wayne, for taking time out tonight to explain, factor investing, making the grade, and it's been very informative. Appreciate it. I learned a lot.
Well, thank you, Derek, for taking out of your vacation time to be my preferred moderator. So that's you make me look good.
No problem. Thank you. I just want to give a heads up to everyone out there. Please, be sure to tune in to next Wednesday's webinar. We're editor of the AAII Journal. It's Charles Rotblut. He'll be introducing the AAII way for creating a wealth plan. And the webinar will focus on a process for creating your own personal investing plan. The following week, on July 8th, you'll actually be getting a double dose of Charles, as he will be discussing using value, momentum, quality as an active approach to investing. And then in 3 weeks, on Wednesday, July 15th, Wayne will be back, and he's going to cover investing like a stock superstar, value investing with a twist. And you won't want to miss any of these informative and educational Wednesday webinars, that's for sure. And as always, you can view the full listing of upcoming Wednesday webinars at www.aai.com/webinars. And this concludes tonight's webinar. And I just want to thank everyone for attending, and stay healthy and safe. Thanks, and have a great evening.